Hello and welcome back. This is Dr. Moultrie. We will continue our discussion on Chapter 1, Corporate Finance and the Financial Manager. This is Part 2. So today we will continue our discussion on Chapter 1 on the subject of corporate finance and the financial manager. We'll continue to provide an overview of the 4 types of firms. We'll delve into the role of the financial manager within these firms and their significance in the corporate structure. We will also discuss the stock market and the pivotal role of financial institutions in the broader financial landscape. So let's dive into the world of finance together. So we left off, we were talking about the S corporations. So unlike traditional corporations, S corporations do not face corporate taxes on their profits or losses. Instead, these financial outcomes are allocated directly to the shareholders based on their ownership stake in the company. Now, although the firm itself isn't taxed, stakeholders are required to report their portions of profits as income on their individual tax returns, irrespective of whether they receive any distributions. The unique tax structure allows S corporations to bypass corporate level taxation and instead transfers the tax liability directly to the shareholders, who then account for these profits, of course, in their personal tax filings. The designation of S, as you all know, comes from subchapter S of the Internal Revenue Code. S corporations elect to pass corporate income, losses, deduction, and their credits through to their shareholders for federal tax purposes. The tax implications for corporate entities on the C corporations. Now, they are the prevalent corporate structure. They face taxation on their profits at the corporate level. Now, this means the corporation itself is liable for taxes on its earnings. However, when these profits are distributed to shareholders as dividends, individuals are required to report and pay personal income taxes on these dividends. Now, this results in a scenario where shareholders in a C corporation experience double taxation, as the corporation pays taxes on its profits and shareholders upon receiving dividends. They are taxed on this income again at the individual level. Now, this dual taxation aspect is a distinctive feature of C corporations that can affect the overall tax burden on both the corporation and its shareholders. So the letter C is for C corporation actually originates from the subchapter C of the Internal Revenue Code. C corporations are standard. They're traditional corporations that are fixed separately from their owners, who are the shareholders. Here you see table 1, which lists the characteristics of the different types of firms. You have your sole proprietorship, partnership, and limited partnership on this table. Of course, you know, we've already discussed the sole proprietorship. The person, the individual, it's of course, the company, the business is owned and operated by a single individual. The owner has a limited personal liability for the business debts. They are the sole decision maker with complete control over the business operations. And the individual or the individual, the business income is taxed as personal income of the owner. And sole proprietorship is the simplest and least costly to establish. Partnership ownership, of course, is owned by two more individuals who share profits. They share losses and management responsibilities. Now, the partners have joint and several liability for debts, meaning they can be personally liable for the actions of other partners. Partners also collaborate on decisions, but specific rights and responsibilities are outlined in the partnership agreement, or it should be. With partnership, profits are taxed as personal income for partners, and partnership requires a partnership agreement outlining the terms, the responsibilities, and profit sharing. We'll discuss limited partnership on the next slide. Limited liability company, or LLC. The owners are called members. They can have one or more multiple members. They provide limited liability protection, which of course is separated. Well, their personal assets are separate from business debts. With LLC, it can be either member managed or manager managed, which offers flexibility in the operation. They can choose to be taxed as a partnership or corporation, combining limited liability with pass-through taxation. With the LLC, the requirement is that they file articles of organization with the state and create an operating agreement. The S corporation, again, is the type of corporation that elects to pass corporate income, their losses and deductions and credits through to its shareholders for federal tax purposes. The shareholders are limited to 100 or fewer and must be a U.S. citizen or resident. They have certain trusts or estates. With the S corporation, they avoid double taxation as it is a pass-through entity. Profits and losses are passed through to the shareholders and reported on their individual tax return. The corporation itself does not pay federal income tax, except for certain taxes like payroll taxes. They also provide limited liability protection to the shareholders, meaning their personal assets are typically shielded from corporate debts and liabilities. With the S corporation, it begins as a C corporation, but then they must file a certain form, which is 2553 with the Internal Revenue Services to elect the establishment of an S corporation status. They have to do it within a specific time frame, and they have to meet, of course, eligibility requirements. However, they are restricted. They're subject to certain restrictions on the types of shareholders, such as limitations on the number and type of shareholders, and only one class of stock. They are managed by directors and officers, similar to a C corporation, with shareholders having ownership, but generally less involvement in the day-to-day operations. The financial manager. Now, the financial manager plays a pivotal role in overseeing a company's fiscal health. They're entrusted with three primary responsibilities. First, they are tasked with making crucial investment decisions, evaluating potential projects or assets to ensure they align with the company's objectives and yield favorable returns. Secondly, financial managers, they handle financing decisions, determining the optimal mix of debt and equity to fund these investments, while they are considering the company's capital structure and cost of capital. And last but not least, financial managers, they manage short-term cash needs, ensuring the organization maintains liquidity by efficiently managing cash flows, handling day-to-day expenses, and implementing strategies to optimize cash reserves for operational continuity and financial stability. Now, these multifaceted responsibilities, they do place financial managers at the core of strategic decision-making, influencing the company's long-term growth and financial success. Financial managers, well, I would say the financial managers shoulder the crucial responsibility of making investment decisions that would significantly impact a company's trajectory. Financial managers are tasked with evaluating various investment opportunities. They meticulously weigh the costs and benefits associated with each project or ventures. So by conducting comprehensive analysis, financial managers assess the potential risk and returns, determining which investments align as prudent uses of the capital stockholders have entrusted to their firm. So the financial manager, their expertise lies in discerning the viability and profitability of potential ventures, ensuring that selected projects not only generate favorable returns, but also align with the company's overarching goals and strategies. This intricate decision-making process, it shapes the allocation of resources and influences the firm's ability to grow and thrive in the long run. The financial manager faces the critical task of determining whether to seek additional funds from current or new stakeholders through issuing more equity shares or opt for borrowing funds through bonds and other forms of debts. Now, this decision-making process involves weighing the advantages and definitely the risk that are associated with each financing method to meet the company's financial needs effectively. The financial manager's responsibility involves maintaining adequate liquidity for the company to fulfill its daily financial commitments. Now, this task, often referred to as managing working capital, it focuses on ensuring the firm possesses sufficient cash reserves to meet its short-term obligations effectively. Now, one of the primary aims of financial management is to optimize the wealth of the shareholders, emphasizing the maximization of their overall value and returns. While stockholders maintain ownership of the corporation, they depend on financial managers to actively oversee its operations. The corporation is primarily under the direct control of the board of directors, and the management team are led by the CEO. So within the corporate hierarchy, the financial manager holds a strategic position, functioning as a key player within the broader management structure. Situated amidst the corporate management team, which includes top executives overseeing various aspects of the company, the financial manager serves as a crucial advisor. Now, the financial manager's role involves collaborating with the board of directors, a group elected by shareholders who wield the ultimate decision-making authority within the corporation. Also, the financial manager works in tandem with the CEO, who is the individual entrusted with overseeing the corporation's day-to-day operations, implementing policies, executing strategies delineated by the board of directors. So this collaborative synergy ensures that financial considerations are integral to the overarching decisions and policies formulated within the corporation, aligning financial strategies with the company's overall objectives and ensuring fiscal prudence in its operations. Here you see the financial function within a corporation. You have the board of directors, the CEO, the CFO, the controller. You have the accounting department, the tax department. You have the treasurer, capital budgeting, risk management, credit management, chief operating officer. Here in this figure, you see figure 1-2, you see the financial functions within the corporation. The board of directors leads to the CEO, which in turn leads to the chief operating officer, COO, and the CFO, the chief financial officer. The chief financial officer has the treasurer, and the treasurer leads to capital budgeting, risk management, credit management. Then you have the controller here, right? That leads to accounting and the tax department. Amidst the complex dynamics of corporate governance, the financial manager's position within the corporation is intricately tied to ethical considerations and incentive structures. Now, this role encompasses navigating agency problems, where the financial manager or financial managers might prioritize personal gain over shareholders' interests, prompting ethical dilemmas. Aligning with these challenges, the CEO's performance holds profound significance, especially when stock performance falters. So in such instances, you have repercussions, right? Repercussions reverberate across the board. The board of directors might consider replacing the CEO to revamp strategies and uphold shareholder value. Simultaneously, the vulnerability to cooperate or to corporate raiders initiating hostile takeovers looms. You could possibly have that issue. So the financial manager's place within the corporation is not only about optimizing financial strategies, but also it is also about fostering ethical conduct and aligning incentives to safeguard shareholders' interests amidst ever-evolving corporate landscapes. The stock market. Private corporations have a restricted number of owners and they lack an organized market for their shares. So in contrast, public corporations have numerous owners and their shares are actively traded on an organized market, which we know as the stock market. Here you see in figure 1.3, there are two pie charts. It is on the worldwide stock market ranked by two common measures, the largest stock markets in the world, which is A, okay, by total value of all domestic corporations listed on the exchange at year-end 2021. And then you have B by the total volume of shares traded on the exchange in 2021. The stock market operates through primary and secondary markets, serving as a platform for trading securities. In the primary market, companies issue new stocks or securities to raise capital, while the secondary market facilitates the trading of existing securities among investors. Traditional trading occurs on prominent exchanges like the New York Stock Exchange and NASDAQ, where market makers and specialists play pivotal roles. Market makers facilitate trading by quoting bid and ask prices, representing buying and selling prices, okay, with the difference known as the bid-ask spread. I'm pretty sure you've heard that term before. Specialists, on the other hand, oversees specific stocks, ensuring smooth trading and maintaining liquidity. Now, liquidity is a measure of how easily assets can be bought or sold, influences the bid-ask spread and transaction costs, which are costs that are incurred during the buying or selling process. So, understanding these dynamics is crucial for investors who are navigating the stock market's intricacies. New competition, market changes, dark pools. So emerging competitions and shifts in the market landscape have introduced several elements. You have the limit order, which is a directive to buy or sell a security at a specified price or better. The limit order book is a record of all outstanding limit orders displaying buy and sell prices for a specific security. Then you have your market orders. These are instructions to either buy or sell a security immediately at the prevailing stock market price. You have what they call the HFTS, which is a high frequency traders. Now, these are entities executing rapid automated trades, leveraging advanced technology for quick market gains. And then there is dark pools. Now, this is a platform where trades occur privately and do not reveal their limit order books to the public. They are often used by institutional investors for larger transactions with reduced market impact. Here you see figure 1.4, distributing of trading volume. Okay, it says distribution of trading volume for NYSE listed left panel and NASDAQ, right? So the NYSE ARCA is the electronic platform, trading platform of the NYSE, and BATS and Direct Edge merged in 2014. Now, these new electronic exchanges now handle about 20% of all trades. Other venues, including internal dealers, platforms, and so-called dark pools, accounted for almost 40% of all trades in 2015. Listing standards. Listing standards delineated the criteria that companies must fulfill to be eligible for trading on an exchange. The NYSE listing standards are notably more rigorous compared to those of NASDAQ, setting high benchmarks and requirements for companies seeking to be listed on their exchange. Other financial markets beyond stocks include bond market, foreign exchange market, commodities market, and derivative securities. Bond market is where debt securities such as government or corporate bonds are bought and sold, enabling entities to borrow or lend money. The foreign exchange market, sometimes people call it Forex, it involves the trading of currencies, allowing participants to exchange one currency for another based on varying exchange rates. The commodities market, it deals with the trading of physical goods like gold, oil, agricultural products, etc., allowing for speculation and hedging against price fluctuations. And then you have the derivative securities. Now, these are financial instruments whose value is derived from an underlying asset, such as options or future contracts, and they're utilized for risk management or speculative purposes. Financial institutions. Now, financial institutions encompass entities offering a spectrum of financial services, including accepting deposits, managing investments, facilitating financial transactions, and providing loans. Now, these institutions serve as crucial intermediaries within the financial system, and they are catered to diverse needs ranging from individual savings to corporate financing and investment management. The financial cycle. The financial cycle begins as individuals invest and save their money, which is then channeled into the market through loans and stock offerings. Now, this capital flows to companies, enabling them to fuel growth by developing new products or expanding operations, resulting in profits and wages, right? So eventually these profits and wages, they circulate back to the savers and investors, which completes the cycle of the financial activity. Here in figure 1.5, you see that this figure depicts the basic financial cycle, which matches funds from savers to companies that have projects requiring funds and then returns the profits from those projects back to the savers and investors. Types of financial institutions. Of course, you know that financial institutions encompass of a diverse range. You have your banks and credit unions. They facilitate deposit taking, they lend, and they provide various financial services for individuals and businesses. Insurance companies, well, they offer protection against financial losses through various insurance policies. Mutual funds, they pool funds from multiple investors to invest in diversified portfolios of stocks, bonds, and other assets. Pension funds, well, they manage funds contributed by employers and employees to provide what? Retirement benefits. Then you have your hedge funds. Invest pool funds in a range of assets, employing diverse strategies, often for high net worth individuals and institutions. Venture capital funds is where they invest in startups or early stage company in exchange for what? Equity ownership. And last but not least, private equity funds. They acquire ownership stakes in companies, and their aim is to enhance value before selling or exiting the investment. Financial conglomerates or financial services firms consolidate diverse financial institutions into a unified entity. These conglomerates, they combine banking, insurance, asset management, and investment banking services under one roof. And their aim is to deliver comprehensive solutions tailored to diverse customer requirements. Their goal also is to capitalize on synergies across various financial sectors, offering an extensive range of services to meet a broad spectrum of financial needs. Here in table 1.2 is the financial institutions and their roles in the financial cycle. You have your banks and credit unions. Examples are Wells Fargo, SunTrust. Insurance companies like Liberty Mutual, Allstate, mutual funds. You have Vanguard, Fidelity. Then you have your pension funds. You have CalPERS and rest. Those are just a couple of examples. We'll move on to the next. Here, the continuation, you have the hedge funds like Bridgewater, Citadel. You have venture capitals like Kleiner Perkins, Sequoia Capital. And then you have the private equity funds like TPG Capital and KKR. The financial institutions play a pivotal role, not a pivotal role, but they play pivotal roles, because several roles in our economy. They do. They act as intermediaries, channeling funds from savers, those with surplus funds, to borrowers, those in need of funds. They manage time value of money by allowing funds to move through time. Financial institutions enable savings to be invested for future use or for longer-term projects. And in risk management, they assist in spreading and mitigating risk by diversifying investments across various assets, whereby they are reducing the impact of potential losses on individual savers or investors. And that is the end of part 2 of chapter 1. Thanks for watching, and don't forget to like and comment. Also, subscribe to my channel. Until next time.